sit there staring at your screen, believing you've discovered the Holy Grail. 1 to 3. Risk $1, make 3. It sounds so simple, so elegant, so perfectly mathematical that you've convinced yourself this is the answer to all your failures. But let me tell you something that's going to hurt. That ratio you worship, it's the most expensive lie you'll ever buy. I've watched thousands of traders destroy themselves chasing this illusion. They enter trades they have no business taking because the math looks good on paper. They hold losing positions past their natural exit because they need that 3-to-1 payoff to feel justified. They pass on legitimate opportunities because the reward doesn't measure up to some arbitrary standard they read in a book, written by someone who never risked a dime of their own money. Risk-reward ratios create the illusion of control in an environment that cannot be controlled by formulas alone. You need to understand what you're really doing when you calculate that 1 to 3 ratio before every trade. You're not planning, you're not strategizing, you're building a psychological fortress to protect yourself from the terrifying truth that you have no idea what the market is going to do next. The ratio makes you feel scientific, makes you feel professional. It gives you numbers to write down, percentages to calculate, probabilities to convince yourself that you've got an edge. But here's what it really is. It's a security blanket. It's a way to pretend that you can impose order on something that has its own agenda, its own rhythm, its own brutal indifference to your plans. The market is not a slot machine. It's not a roulette wheel where you can calculate odds and expected values. It's a living, breathing entity made up of millions of decisions, billions of dollars, fear and greed and panic and euphoria all mixed together into something that moves in ways no formula can predict. And you think your little 1 to 3 ratio is going to tame that? You think you can reduce that complexity down to a simple equation? What happens is this. You start believing your own mathematics. You enter a trade and you've already decided what the market owes you. $3 for every one you risk. That's the deal you've made in your head. But the market never agreed to that deal. The market doesn't even know you exist, so when it gives you $2 and starts to reverse, you hold. When it gives you $1 and the momentum dies, you hold. When it takes back everything and approaches your stop, you start questioning whether your stop is in the right place, because surely the market will come back and give you what you deserve. The ratio has blinded you. It's made you deaf to what the market is actually telling you. Every price bar, every volume spike, every failure to push higher is information. But you're not processing that information anymore. You're just watching your target, waiting for the market to fulfill your formula. That's not control. That's delusion. Real control is being able to adapt to what's happening, to change your mind when conditions change, to take less when less is all there is. Your ratio has taken that power away from you and replaced it with false certainty, and that false certainty is going to cost you everything. Holding for arbitrary targets causes traders to ignore market signals that indicate when a move is exhausted or invalid. The market is screaming at you to get out, and you're sitting there with your fingers in your ears, humming to yourself about ratios. I've seen it 1,000 times. The price action turns sloppy. The momentum dies. Volume dries up. Every single thing about the way the market is moving is telling you this trade is done, but you don't exit because you haven't hit your target yet. You risked 1. You need 3. That's the rule. So you hold through the deterioration. You hold through the warning signs. You hold through the reversal that starts slowly and then picks up speed. And somewhere in your mind you know what's happening. You can feel it. But you override that feeling because the ratio is more important than the reality. This is where most traders destroy themselves, not in the entry. The entry was probably fine, not in the stop placement. The stop might have been reasonable. They destroy themselves in the hold. They destroy themselves by being loyal to a number instead of being loyal to what the market is actually doing. A professional trader watches the price action every moment they're in a trade. They're looking for continuation signals or exhaustion signals. They're reading the tape. They're feeling whether the move still has power or whether it's running on fumes. And when they see exhaustion, they get out. They don't care if they only made half of what they hoped. They don't care if they're walking away from potential profit. They care about taking real money while it's still there to take. You're not doing that. You're watching a number on your screen. You're waiting for that target to get hit. The market could be falling apart around you, and you wouldn't notice because you're hypnotized by what you think should happen, instead of responding to what is happening. Here's what you don't understand. That target price you set is fiction. You made it up. Maybe you measured a previous swing. Maybe you used some indicator. Maybe you just multiplied your risk by 3. But it's still fiction. It exists in your head, not in the market. The mark. ET has its own target, its own natural stopping point, and that's the only target that matters. When the market tells you it's done, you listen, or you pay. Your arbitrary target is costing you winning trades. You're turning profits into losses because you won't take what's real while you wait for what's imaginary. Ratio requirements force traders into marginal setups they would otherwise pass, increasing losing trades disguised as disciplined entries. You're taking trades you have no business taking and you're calling it discipline. Let me explain how this works. You're sitting there watching the market, and you see something that's almost a setup. It's not quite right. The timing feels off. The momentum isn't there. Something in your gut is telling you to wait. But then you start calculating. If I put my stop here and my target there, I get my 3-to-1. The math works. The ratio is good. So you talk yourself into it. You override every instinct that was telling you to stay out, and you enter that trade because the numbers made it look legitimate. That's not discipline. That's rationalization with mathematics. Real discipline is staying out when the setup isn't there. Real discipline is watching paint dry for hours or days until you see something that's actually compelling. Real discipline is being able to sit on your hands when you're bored, when you're itching to trade, when you want action so badly you can taste it. That's hard. That requires real strength. Following a formula is easy. Your ratio gives you permission to trade. It gives you a reason to pull the trigger when you should be waiting. You're not even aware you're doing it. You think you're being systematic, following your rules, being a good trader. But what you're really doing is finding ways to justify trades that shouldn't exist. I did this for years. I'd see something marginal and I'd spend 5 minutes measuring and calculating until I found a way to make the ratio work. Then I'd take the trade and act surprised when it lost. I'd tell myself it was just part of the process, just probability playing out. I never stopped to ask whether I would have taken that trade if I wasn't trying to hit a ratio. The truth is, most of those trades never had a real edge. They were manufactured by my need to trade and validated by math that had nothing to do with market conditions. I was creating opportunities that didn't exist because I needed my account to be doing something, anything, and the ratio gave me a scientific-sounding excuse to gamble. You're doing the same thing right now. Half your losing trades wouldn't exist without that ratio pushing you into them. You're increasing your trade frequency, lowering your standards, taking marginal setups, all because you can make the numbers work on paper. And every one of those trades costs you money and confidence. The market determines what it will give on each trade. The trader's job is to take what is offered, not demand predetermined returns. You walk into the market every day with your hand out, demanding your $3. You think trading is a negotiation. You think if you risk $1, you've earned the right to get 3% back. That's not how this works. That's never been how this works. The market doesn't negotiate. It doesn't care what you risked. It doesn't care what you need or what you think you deserve. The market is going to move how it's going to move. Some days it gives you a quarter, and the move is done. Some days it gives you 10 times what you risked and keeps running. You don't get to decide which day is which. You don't get to impose your will on price action. Your only job is to read what's happening and respond accordingly. This is the fundamental shift that separates professionals from amateurs. Amateurs come to the market with demands. They need a certain amount per trade to make their system work. They need specific ratios to feel like they're trading properly. They need the market to behave in ways that fit their plans. And when the market doesn't comply, they hold and hope and pray and eventually lose. Professionals come to the market with empty hands and open minds. They're there to take what's given. If the market offers a small profit and the move looks tired, they take it with gratitude. If the market offers a massive profit and the momentum is still building, they press harder. They're not attached to outcomes. They're not married to targets. They're dancing with the market, not fighting it. You need to become humble before the market. Not in a weak way, not in a defeated way, but in a way that recognizes reality. The market is bigger than you. It's stronger than you. It's been here longer than you, and it will be here after you're gone. It operates on its own terms. You can either accept those terms and work within them, or you can keep demanding your 3-to-1 and keep losing. Every time you hold past the natural end of a move because you haven't hit your target, you're demanding instead of accepting. Every time you refuse to take a profit because it's not big enough, you're negotiating with something that doesn't negotiate. The market gives what it gives. Take it. Be grateful. Move on to the next opportunity. That's the only way this works. Rigidity masquerading as discipline destroys more accounts than impulsive trading because it overrides judgment with mechanical rule following. You think you're being disciplined, but you're actually being stupid. There's a difference, and you need to understand it before it costs you everything you have. Discipline is doing what's right, even when it's hard. Rigidity is following a rule even when it's wrong. You've confused the two and it's killing you. I watch traders sit in losing positions, watching their equity bleed out, and they tell themselves they're being disciplined because they're following their plan. The plan says the stop is at a certain price, so they hold. Never mind that the entire character of the market has changed. Never mind that the thesis for the trade has been invalidated. Never mind that every experienced bone in their body is screaming at them to get out. They have a rule and they're going to follow it even if it destroys them. That's not discipline. That's cowardice dressed up as virtue. Real discipline requires courage. It requires you to make hard decisions in real time based on incomplete information. It requires you to override your plan when your plan is wrong. That's terrifying because it means you have to think. It means you have to trust your judgment. It means you can't hide behind rules when things go bad. Following rules is easy. Any robot can do it. Any algorithm can do it. But robots and algorithms don't make money in markets over the long term because markets aren't mechanical. They require human judgment, human intuition, human ability to see patterns and read context and understand when conditions have shifted in ways that demand a different response. Your rigid adherence to ratios and stops and targets is your way of avoiding responsibility. If you follow the rules and lose, you can blame the rules. You can blame probability. You can blame bad luck. You never have to look in the mirror and admit that you saw what was happening and chose to ignore it, because thinking for yourself is harder than following a formula. The traders who make it are the ones who can follow a plan right up until the moment that plan becomes wrong, and then they can abandon it without hesitation. They're disciplined. Enough to have a structure but flexible enough to adapt when reality demands it. They're not slaves to their systems. They're traders using systems as tools, not as replacement brains. You're a slave right now. Your ratio owns you. Your rules own you. You've given up your judgment to a formula, and you call it discipline. It's not. It's abdication. True trading skill is built on reading market character and rhythm, not on achieving mathematical ratios that exist independent of price action. You want to know what separates a real trader from someone who's just gambling with formulas? A real trader can look at a chart and feel what the market is trying to do. They can sense when a move has power behind it, and when it's just noise, they can tell the difference between a market that wants to trend and a market that wants to chop. They've developed an instinct that comes from thousands of hours of watching price action, not from calculating ratios. This instinct can't be taught in a book. It can't be reduced to a formula. It can't be systematized or automated or turned into a simple rule that works every time. It's a skill that develops slowly, painfully, through experience and attention and the willingness to actually see what's in front of you instead of what you want to see. But you're never going to develop that skill if you're staring at ratio calculations all day. You're never going to learn to read the market if you're measuring targets instead of watching how price moves, how it tests levels, how it builds momentum or loses it, how volume confirms or contradicts the price action. That information is all there. The market is constantly telling you what it wants to do, but you're not listening because you're too busy doing math. Every market has a personality. Some days it's aggressive and directional. Other days it's tentative and choppy. Some moves are smooth and powerful. Others are jerky and unstable. A trader who can read this character knows when to press hard and when to trade small or not at all. A trader who can't read it is just guessing and hoping their ratio will save them. Your ratio blinds you to all of this. It makes every trade the same in your mind. Risk 1, target 3, set it and forget it. But every trade isn't the same. Every market condition is different. The approach that works in a strong trend will destroy you in a range. The position size that's appropriate when the market has conviction will leave you overexposed when it's uncertain. You need to stop trading numbers and start trading markets. Watch how price behaves at significant levels. Notice how it accelerates or stalls. Feel the difference between a healthy pullback and a reversal. Learn to read the story that price action is telling you. That's the skill that matters. That's what will make you money, not your ratios.